this tends to become a very frequent question every time the index hits highs. Is it a good time to invest? Because it's not intuitive, right? Once the index hits highs, we're expecting that it's going to fall from there, and therefore people often hesitate whether to invest or not. So we said, okay, let's just look at the data and see what the Nifty tells us. So we looked at data from about July 1999 to November of this year. Essentially, this chart shows the Nifty along with the shaded regions being the times when the Nifty hit an all-time high. Essentially, an all-time high up to that point, obviously. So you can see that there are quite a few shaded regions through the course of the chart, because as in general, the trend of the index has been up over the long term, which is why we even bother investing in equities, right? So um, overall, roughly about 713 days out of the 5,800 days of data that we're looking at, the Nifty has hit an all-time high, which is almost like 12% of the time, which is quite significant. So the question then is, if you were to invest during those shaded regions, at the times when the index was hitting highs, would you have done really badly, or what would your outcomes have been like? And that's really what we set out to answer. Krishna, if you can go to the next. So just to explain this chart, so this chart is essentially a frequency distribution of 1 year returns of the Nifty if you were to invest on every day that the Nifty has been around since back in 1999. So on the x-axis you have the different return buckets, which is going from extremely negative right down to like negative 60%, which happened in 2003, I believe, to positive 105%, which happened sometime in 2013. And how often that happens as a percentage of all the days that the Nifty has been around. So the sum of all these bars would total to 100. And then you can see that the most frequent return that the Nifty has done over a 1 year period has been between 10 and 15%. That's happened roughly 11% of the time. 27% of the time, the Nifty's 1 year return has been negative. So to put it another way, 73% of the time, if you are to invest in the Nifty, your return would be positive 1 year down the line. So just to set the context, now what we are looking to answer is, instead of this, if you were to invest at highs, what happens? Next page, Krishna. So this is if you were to invest at highs during those shaded regions that we saw in the chart on the previous page. It turns out it's not that dramatically different. So the x-axis is the exact same width, so that you can visually compare how the two return distributions look. What you see is that you still see negative returns 28% of the time if you were to invest in the Nifty at highs, which is actually not that bad if you were to think that overall your negative returns come when you about 27% of the time. Investing at highs just doesn't change that dramatically. It's roughly the same. Your most frequent return also is between 10 and 15%. So even if you were to invest at highs, your most expected return over 1 year is 10 to 15%. Obviously, that's happening roughly 16% of the time. The remaining time, it's a return that could be lower or it could be higher as well. What is different is probably that long tail on the right is missing when you invest at the highs. So those returns which are exceeding 60% over 1 year, you don't see when you invest at an all-time high, and which makes sense because the really big years tend to come after big correction years. So since we are investing at highs, obviously that correction hasn't happened, which case, which is why you don't see that extreme right tail of returns. But the negative side seems to be roughly consistent, whether it's investing on any given day or at highs. So that's almost kind of reassuring to see that your chances of positive returns are almost the same with whether you invest at highs or at any other time. Next page, Krishna. So this is a summary of those two charts, and also a third scenario, which is what if we were to invest on any day except when the Nifty is making highs. So this chart essentially compresses what we saw on the previous page into a single bar. So you've got catastrophic returns on the extreme left, which is the red. You've got something that's down over 30% over 1 year, and then so on up and going to the right, where you get those extreme positive returns. So again, that you don't see a significant difference if you were to invest on any given day versus any at all-time highs or on any day except for highs, you just see a slight difference in the distribution, in the sense that if you were to invest at highs, you can see that the width of that red bar on the left is slightly broader, which totals to about 2%. So your chances of a really bad return are 2% compared to about 0.6% if you were to invest at any other time. So this chart is meant to essentially summarize that, look, it doesn't make that much of a difference. Your chances of negative returns are roughly the same, maybe slightly higher. Your chances of extremely positive returns go down, but overall you're in the same ballpark from a 1 year return perspective, and whether you're investing at any other time or at index highs. Next page, Krishna. So, but there's an interesting point to make. We looked at the 1 year return. So these are essentially the same two charts. 1 year return from investing at any time except the highs, and if you were to invest at highs, you can see that the distribution is roughly the same. Like we mentioned, significant range of possible outcomes, right down to negative 60% to positive 105%, which is a massive range. Except that when you invest at times that are not highs, then your chances of extreme high returns are slightly higher, and your chances of extreme low returns are slightly lower. But then what happens if you sort of zoom out and increase your time frame from 1 year to, let's say, 3 years? Next page, Krishna. So these are the same charts. If you were to look at returns 3 years from there, the numbers on this chart are annualized. So they're comparable across the four charts that you see. So what you see visually is that the shape of the chart has completely sort of compressed from those really wide tails. It's now become a much narrower range of outcomes, which is very interesting. So, for example, if you were to look at the parts of the chart that show negative returns, your probability of negative returns goes down to 7% if you were to invest at any time other than highs over a 3 year period. That's down from 27% in any given year, which means your probability that you will make losses drops by 2/3 by holding for 3 years as opposed to just looking at it 1 year hence. At highs, though, that the probability of negative returns is 18.7%, which is still down from its 28%, but it's higher than if you were to invest at other times that are not highs. But what you do see here is the left side of the chart side of compresses, where the probability of negative return significantly goes down, which obviously means your probability of positive returns goes up. But at the same time, the probability that you're going to make extremely positive returns also goes down. So your returns now start to come into this narrower range the more time that you spend in the market, which is something that you would see if you were to look at even active mutual fund returns going from 1 year, 3 year, 5 year, 10 year. That range of the range between the best performing and the worst performing tends to really narrow quite a bit as you increase that time frame. So hence that classic saying of time in the market is significantly more important than timing the market. Next page, Krishna. So then we looked at one corollary of the above discussion, which is, okay, instead of investing at highs, what happens if you invest at lows? Instead of lifetime lows, we looked at 52-week lows. So we said, what if you invested every time that the Nifty was within 5% of the 52-week low at that time? So this is the return distribution of that. So you can see now that it looks better overall than the other charts that we've been seeing. Your negative returns, your probability of negative returns is significantly lower. In fact, your worst return, if you were to do this, would be something like minus 35% in 1 year, while your best return could be, goes all the way till 105. In fact, 10% of the time when you invest close to a 52-week low, your returns could be over 70% for the next year, which is intuitive given that you're at a 52-week low because the market's corrected significantly. And then if you were to invest money at that time, your chances of good returns are significantly higher. Obviously, this chart then makes it look like, so why won't we just do this? Why won't we just invest every time that the market is at a low? But I'll draw your attention to at the bottom of the chart, you see n is equal to 390, which means that this happened only on 390 days out of the 5,800 days that we considered, which is like 6% of the time. which means that if you were to apply this strategy to say that I'm going to only enter or invest when the market is close to a low, and at any other time I'm not going to be investing, you would be out of the market quite a bit, and therefore your opportunity to actually get this kind of a return would be significantly impaired. So, what the academic learning from looking at this chart is that 52-week lows are pretty good times to deploy more money. If you happen to have some extra cash lying around, that's probably a great time to add that in as part of your existing investments. But obviously, it doesn't work as a long-term strategy, simply because 52-week lows do not happen that often. And so, just to summarize all of this, Krishna, next page. So, the on a 1 year time frame, the Nifty is going to give you a very wide range of returns, all the way from -60 to 105%. We always talk about a Nifty typical 1 year return of 12%. That's your expected return from the Nifty in any given year, but that almost never happens. That only happens roughly 10% of the time. So when you're planning for, let's say, something like a 3-5 year time frame, assuming that you're going to get 12% per year for 3 or 5 years is probably going to give you some pretty wrong outcomes. So the 12% happens over a long period of time, not in any given year, and that's very important to keep in mind. Investing at highs, we've seen that the chance of negative returns is roughly the same as if you were to invest at any other time. Maybe slightly worse, but not significantly. If you increase your time horizon from 1 year on, your chances of negative return actually drop quite significantly. So it was roughly 27% if you looked at it on a 1 year basis, but if you looked at it on 3 year basis, it comes down to 9%. So that's almost like a 2/3 reduction in that chance of negative returns. And obviously, once you go further to 5 year and 10 years, that 9% comes down almost to zero by the time you get to 5 years. And your chances of getting zero negative returns is almost non-existent on a long-term horizon. And lastly, that strategy of investing at 52-week lows, it does look great. Its expected return is higher than if you were to invest at any other time, but it only happened on a very few number of days over the last nearly 22 years. 390 days is what we saw. So you couldn't possibly spend your time waiting for a 52-week low to invest. But yeah, if you have a big lump sum, then a low is probably a better time to invest than a recent all-time high. You can read the full post on the Capital Mind website. It's there. The title of the post is "Should You Invest at Market Highs?" We've gone into a little more detail in that, so in case anyone's interested.